S&P gapped down early in the morning based upon possibly losing another bank, First Republic Bank this time. But as the day progressed, we started to lift, and it became increasingly clear that other banks were going to step in to help them. We have the Fed that is looking at possibly not being as aggressive in raising rates, and we saw several inflows into the market. Specifically, technology continued to outperform. We saw a lot of buying towards that last hour that we've been talking about now for weeks. We're going to go over that tonight, what institutions are doing, how they're positioning themselves, what caused the huge rally in FRC and why is it down $6 after hours? Why was preferred stock up 54% today when FRC was only up 9%? The smart money, dumb money confidence indicator and what it's telling us right now. How this one indicator has been telegraphing moves for us since the beginning of the year. Welcome back, everybody. S&P futures rallied today, and we're going to start by looking at the futures and dig into the index. But I like the futures right now, obviously, because they are more continuous and just shows exactly what's been going on. You can see how we completely respected the 3,900 level. You can see this extremely clearly right here, how you have this DTL sitting right there, waiting for that to reject. Do we think that's going to reject or not? Well, there's some things that are telling us that maybe not. We're going to have to see how this plays out, but crisis avoided in a couple different areas today in the banking sector, and this has led to some to believe that we're actually entering more of a Goldilocks period than what we first originally thought. And we're going to address that very shortly. But if we take a look at that and we look at the S&P in regards to the Nasdaq, this is a no-brainer looking at this chart in comparison. We can see the Nasdaq futures up top and the S&P below. Look at the curvature that we have going on here. We have this beautiful sweeping motion we've had since the October lows that were put in by a CPI number and a reversal in the dollar. We've been talking about that reversal in the dollar for some time. We're going to cover it a little bit tonight, but there's a lot to go over with quad witching and what to expect tomorrow. Ways to play quad witching, which I think are pretty significant. So we're going to cover some of that this evening so that you have a battle plan going into tomorrow. Now, here's support. We get to it now. Forms a doji, goes sideways, lifts, sitting at 4,000. All we keep hearing over and over again is how things look they're going to roll. And I have to agree with that. At the beginning of the week, things looked pretty grim. We had bank after bank going under, and then the banks were getting bigger with Credit Suisse. That is what's weighing on the S&P. The S&P is diversified. Diversification works both ways. It works great when one sector is not outperforming. When technology is outperforming and technology is significantly outperforming, the S&P will lag. You do not go into a recession with the Nasdaq ripping and the S&P lagging. Now, before we continue, I'm just going to state the obvious. I am not an economist. That is not my job. My job is to trade. So I just look at what's in front of me, I assess it, and I analyze it. But it's pretty clear that something's going on in technology with all the buying coming in. It is not short covering. We're going to walk through why it's not short covering in a moment. Now, in front of us is a multi-year chart going back about 20 years, actually 22 years. Nasdaq relative performance to the S&P. When you're going through a tough time or you're going through a recession, what will happen is the Nasdaq will underperform, and you'll get signs of that underperformance. Bottoms are formed when you reverse. In other words, when the Nasdaq starts outperforming the S&P, you start to see a reversal in the fortune of the indexes. And that's exactly what you're seeing here. You're seeing this very long trend here. And of course, you're going to have your blips along the way. We've had that underperformance right here for a very short period of time during the pandemic. The reason you're not seeing the dip is because this is relative performance. It's not absolute performance. For example, if I overlay in orange the S&P, you can see the massive drop in the S&P in orange. And you can see how that is not reflective in our chart, and it's not reflective in our chart because this is a relative basis chart, and what we're trying to do is determine, is the Nasdaq outperforming the S&P, which is exactly what any bull wants. Now, if we zoom in right here and focus on that area, I want to be really clear about the global financial crisis. It did not mean that the Nasdaq was not down. Of course it was. The Nasdaq was actually down more than the S&P at this particular time because of the panic. It just held that trend line. It held that reversal. Now, if we go through time, we'll see this continued outperformance until you get this massive, massive move. And look what that massive move led to. It led to a peak. And you can see how we got right back to the absolute peak of this relative strength over multi-decades. Double top, undercut that double top, and that was pretty much it, all she wrote. And then since that break, it's just been S&P outperformance. And the S&P outperformance is not something that we want. We don't want S&P outperformance. We want the Nasdaq to outperform if we're bulls. If you're bears, this is the exact opposite of what you want to see. So what's happening now is we are flipping a DTL or downward trend line, and we are sitting right here at where we broke the double top. So we're setting up for a major move here. It is not taking out that massive high, but what you are doing is you are setting up for a massive move if you can get over that level. Now, it's possible that we're going to start seeing more volume come in the market. We've been talking about this graph probably for the past month and the significance of it. As the S&P has been dropping, you're actually seeing the last hour of trading, which is exactly what this charts. It takes an algorithm and it creates an algorithm to determine, are we seeing more buying at the end of the day or less buying? And then it just adds a +1 or a -1 to that. And you can see very clearly here how this is going up as it's dropping down. That is what we refer to as a positive divergence. We like positive divergences. So who buys in the last hour? Well, as we know that institutions buy in the last hour, and that's who's buying. It doesn't mean they're right, but it's starting to appear that they are fairly accurate in what they've been doing. So if we take a look at that last hour from December on, as they've been accumulating and hitting multi-year highs on the last hour chart, the S&P really has not been dropping. So what's going on? Why is the last hour going up, but at the same time, the S&P going flat? Well, there's a couple reasons for that. Before, the main reason appeared to be that we were dealing with rate hikes that seemed to be under control until the Fed broke something. And now you can see this huge H right here on KRE, and we broke the regional banking sector. We've lost a couple banks, which has added massive pressure to the S&P, which is really led by the financial sector, one of the largest portions of it, which we're going to address in a second. And you can see right here how we're hitting a multi-month base on that level and holding. So this is adding pressure to the S&P. It's a monthly of financials, and you can see the DTL right here, but you can also see the support level and how we're hanging on to major support, and that's important. We drill all the way back to this support level, and we just start right here. You can see where we went to. Let's clear all that off, and then we'll just do it again so we can just focus on that one line, and you can see the significance of what I'm showing you. We came down, we retested that level that came back from the great financial crisis. You can see where we were on the pandemic, and as I like to say, resistance, which is clearly what this is, has flipped. And what has it flipped to? Well, that has flipped to support. And now the fact that that has flipped to support right here is exactly what we want to see. Is it going to hold? Newsflash, nobody knows. Right now it's holding. So this is what we have to go on. This is what we have to pay attention to. We can pontificate about it. We could say the Fed doesn't understand. The Fed needs to do this. None of that makes me money. And that's why we trade, or why I trade. So now we know while they're buying into the last hour that we understand why these sectors are weighing on the market. Now, in order for that to alleviate, we would need the problem to alleviate. Now, the blue line is Credit Suisse. Credit Suisse has just been on a trajectory straight down ever since we've had those beginning hints of a rate hike. And since then, we've never been able to rally at all. And Saudi has just been feeding the machine, buying stakes and investing in the company over and over again till they got to 10%. For regulatory issues, they don't want to invest anymore. The SEC looked into their books and said, we don't like your annual report. We see some things. Credit Suisse took advantage of this opportunity to say, oh, by the way, things aren't going too good and we need capital. Swiss Bank walked away from them until they got pressure from other governments. Now they're going to back them. This was significant because this could really damage the large banking system, which is really the XLF. That's your JP Morgan. And we can see this very clearly just by leaving this line chart on. But that's your JP Morgan, that's your Goldman Sachs. what happened here? Well, enough pressure and the fact that Credit Suisse has in assets what the Swiss GDP is made them come in and say, okay, we're going to help you. And the national bank is actually going to prop them up. Well, this alleviated a lot of pressure. So we can just look at the Nasdaq futures for a moment and go all the way back here to June or July of last year and just really draw across. And you can see, you're bumping in the same areas over and over again. It's like Groundhog Day. And you're getting tighter, making higher highs. Now you have this DTL in here. But we got some relief there today. And that relief that we got at the same time was driven by another sector. But that relief on Credit Suisse let Goldman go up, let JP Morgan go up, both names that you should be focused on. We traded this one fairly well today. I'm just going to give you a really quick tip here that you're going to want to remember. If you're trading right now, you want to buy at support levels and you're looking to sell into resistances. You're not looking for the resistances to break right now. You're not in a breakaway market, although we're starting to get into an area where we might get into a breakaway market. We may discuss some of that today or on this weekend's video, so make sure you subscribe. So here's your line coming across. Here's Goldman, and you touch it, right? And what you're looking to do is you're looking to just set up very simple pattern recognition to get you in and out of trades. So we know that this area has 3 supports in here. All 3 of these supports to me were major. We came down to that level. We clicked a couple other indicators that I was looking at, formed a doji. That's all we needed. Put the trade on, and I gap filled and closed my trade out. You can see the rejection from the gap fill, and then it was just good news after good news, which we're about to address. But that was the trade. Is the trade over? The answer is I don't think it is, but it was over for me on the short-term basis. In other words, that's all I was looking for. So I took my points and it was a day trade for me. I took what I made on it and I very simply got out of the way and went about my day and started looking for the next stock. So now we know financials are holding. Now we know that the issue that was putting pressure on the financial sector, the large financial sector, somewhat solved. Let's call it somewhat. Let's not call it all the way solved because it becomes a can of worms. And quite frankly, we don't know what else is in Credit Suisse. So it's very difficult to just say, oh, everything's rosy. It clearly is not. But we're not bleeding as much as we once were, and we see a light at the end of the tunnel would be the best way to say it. Now, we're already aware that we lost SIVB and SBNY, and we're already aware that other regionals are in trouble. But First Republic Bank was the one that was sorted out, and that was the one that was actually pointed out by the White House. Actually, them pointing that out by the White House let me put a very nice short position on last night, and we covered it this morning right at the open. Last night, very late, they came out and stated that they were going to put the company up for sale. The issue is no one can really buy them. They're too big, and the regulatory time to sort that out would take too long, and they needed liquidity. Well, they got that liquidity today. And once they got that liquidity, we had a really nice, powerful move up. Now, what I did with my short was just very simply lock it in. But this became pretty telling that we had some issues here that we could see the bottom. In other words, that opening price, we never broke that opening price. You never had one close 1 minute below the opening price today. Got to that resistance level, flipped, retested the level twice, unable to break it, pushed, and then what happens to resistance? Resistance becomes support. News starts coming out that several large investment banks and commercial banks are going to inject up to $30 billion into the company. The company is saved and it rallies. You put an anchored VWAP on the peak of the rally and it can just tell you where the players are and you can see why they're starting to get out when you get to that area. And then it tries to flip. Now, the issue is resolved and the bank will be solvent. Why is this good? Because that means that anyone that has their deposits there, whether that's a biotech or whether that's a personal account, doesn't really matter, but their assets are saved. Okay, so that part's fixed. But why is the stock down $4 or now $5 after hours? Well, they're going to suspend their dividend. And when they suspend their dividend, that's when you have a problem for people that own it because of the dividend. They don't like that. The company suspending their dividend should not be that great of a shock to anybody considering that they just almost went belly up. So I'm sure that they're going to be putting in cost constraints across the board. And this may have even been something that they were told to do. In other words, cut your dividend and you're going to pay us interest on this money. Because no one's going to give them $30 billion and then not receive interest or payments on that money. So this should not be a shock to everybody. But what was interesting today was this was not the move. The move was not to go out there and try and buy this. Yes, it would have been great if the company got bought out, but it was probably going to be a take under if they did it. The move was to go out there and find better instruments. Now, over the course of years of trading, there have been 3 times where I've seen scenarios like this. Once was in the late 90s, and it was with the actual funeral department. In other words, funeral stocks. And the reason I bring that up is because they went through this huge amount of consolidation. They overextended themselves. And so you started to see that market crack. When that cracked, they had preferred stock. People started getting out of the preferred stock because they were scared they weren't going to be able to make the dividend payments. The issue with preferred stock is that if you understand why it's preferred over common, you understand that that is actually the better investment. We saw the same exact thing happen during the great financial crisis where people were buying the common, but at the same time you had preferred stock. That preferred stock was what was leading. That preferred stock is what people wanted to go out there and buy. You can see very clearly here that even with this huge move that FRC had today, it was only up 10%. But all of these preferreds were up 54%, 50%, over and over and over again. And the reason for that is because they have to get paid. Whether or not they get bought out or don't get bought out, they're going to get paid. Now, if the company does get bought out, these preferred stock become preferred stock of the buying company. How does that work? Well, very simply, and these are very, very thin. And we did trade these today and we did quite well with them. But the purpose of me showing you this is understanding the game is half the battle, right? It's knowledge, it's information. So these go at parity at roughly 25. This opened today at what, 8, 9, okay, paying 5%. So at the time that this opens, it's actually paying 15% per annum if it doesn't go bankrupt. If the company goes bankrupt, these go to zero, right? They have the probability of going to zero, even though they are preferred stock. So what does that mean? It means that they are preferred over the common, meaning should there be any liquidation, this would be preferred instead of the common shares. Now, as these traded during the day, and let's go to a 5-minute chart on this, this became increasingly clear that you started having buyers step in. And that's exactly what they did. They just continued to step in time and time again. Once you started to see this and you started to see the news and it started to look like there was going to be a bailout right around that 1050 level, you just started seeing a pop in all of these. Every single one of these started to see a pop right around that same time period because it became clear that they were going to save this company. And once it became clear that they were going to save it, that's all they needed to see. Now, if you look at this pop that happened on all these preferreds, and it happened on all of those preferreds around the same time that the stock moved, it's not even close to the amount of money that could have been made in buying the preferred. And the bottom line is, as long as the bank is sound, it doesn't matter if the common goes up or down. You'll just, every quarter, you're going to get your dividend as you're waiting for this to trade higher. The goal with these is relatively simple. What you're waiting for these to do is you're waiting for these to get back to that parity level. They all came out at 25. I don't know that you're going to get back there right away. Let's see, get back to that 21, 22. Then you have the opportunity to sell if you want to, or you can just sit there and hold it. And at this point, you're probably making close to 10% on invested capital. So this is a great thing to do if you're willing to take the risk. Once the financing's in place, it works. This was another trade that we did the other day. I actually covered this trade. And what you're seeing right here, we actually bought right here at like 12.20 pre-market. And then as it traded up, we sold into it, scaled out, sold the rest, and then put a backstop on it around 13.75. I was trying to stay in there longer term, and I hoped that I did not get taken out because I was getting 7.75% at a $25 rate, which means at the time I was getting close to 16% per annum. So my goal was to try to stay in there and see if it traded up. But when we saw the weakness, I should not have had weakness that day. Therefore, we got out of the position. Preferred stock is the way that you want to be looking at these trades right now. Okay. They are, 1, they pay you a dividend. 2, you're going to see more inflows and more stability. And once this settles down, you're going to see the yield hunters come in. So before we get into quad witching and what to look for tomorrow, It's very important for us to grasp a very simple concept. The last hour is going up and they are buying. What are they buying? It's very clear that they are buying semiconductors and tech, and we'll point that out in 1 second here. And we're dropping. But the reasons that we're dropping are changing. Credit Suisse, regional banks, high interest rates. I doubt highly that Powell is considering raising 50 basis points right now. Now, if we look at the technology sector, 45% of this is Apple and Microsoft. Look how we're breaking out. So in the last hour, what are they buying? If we start to drill into this, what stocks are they buying during that last hour? Well, it looks to me like they're buying Apple and Microsoft the last hour, and that's exactly what they did. And then they spread it across several different names, didn't they? Look at how we acted today. Look at how we flipped the DTL right on a major support line today. My goal today was to get to 250. We obviously did that and then some. And we really just ran right into a major support level gap filling. It looks like we're heading to that 260. I mean, these stocks are trading like monsters, guys. This is not how you act in a bear market. People will say, oh, it's a bear market rally. You can sit here and you can call it a blueberry, as I like to say. I don't care what you call it. I have no idea what happens fully next week. But if you think institutions are putting this kind of money to work and that this is just going to reverse and go away, you're not understanding what's happening. There's a reason why you're getting above average volume. Now, for the past month, we've been charting this. This is smart money, dumb money, confidence spread. You see the spread right here? See how smart money and dumb money, and you see the confidence spread and where we're at right now, just on the spread itself between smart money and dumb money. Now, the top of this green line is considered excessive optimism. This is excessive pessimism. What I'm going to do is not utilize these lines. I do this a lot. I just want the data. And then from the data, I will ascertain and use it the way that I like to see it. And what I'm looking for are patterns. That's how I trade. So if I note that when we have these bottom peaks, I'll note that that usually is giving me the high of the market. Let's pull this back down. So that will usually give me the high. We're just going over the spread right now. We're about to go over something else in a moment. And then you look here and you see how we act right there. Isn't that interesting how the bottom once again is right when we're near that red line? Now, they're not all going to work for obvious reasons, but it does seem that when we have these troughs where we have excessive pessimism, that they do seem to be putting in some kind of bottom before turning. This may be an anomaly, obviously, because of the pandemic. But so what do we have here? Well, we have a signal down here that's telling us maybe we had a top right there. Maybe that top was put in. Well, when do we start seeing that reverse? Well, we start seeing that reverse when this pulls up and gets to this level. And when we have excessive optimism on the spread, meaning the disparity between the two lines is the greatest. Disparity between the two lines is the greatest. I'm saying that twice for a reason. So you can see how you're popping up here. And what does that mean? Well, that last time signaled the bottom. So maybe that's something that we should pay attention to. And then when you kind of go through this and you look at it a little bit, you're saying, okay, well, maybe that's something we have to pay attention to. Maybe there's something here between the disparity of these two lines that's giving the spread that is signaling that there is a bottom or a top in place, because it certainly looks like it called it perfectly about 6 months ago. Now we drill into smart money, dumb money. You remember a month ago when we first started looking at this, and for those that are new, we don't refer to this as smart money. We don't refer to it as smart money. We refer to this as funds, because just because funds buy does not mean they're right. Okay, just because they're buying in the last hour in the chart I showed you does not mean that right. It just means that that's what they're doing, right? So let's not read too much into it. We refer to this as fund money and retail. But the disparity that I just showed you is glaring, right? Now, look who's selling. Retail is selling. Look who's buying. Institutions are buying. Look at the disparity that we had and look at how it's inverting. Now let's drill out on this over a 3-month period so you can see exactly what's going on. So when we bottomed here and they were at their lowest point, quote, smart money, short term, when they were at their lowest point invested, we hit a top. Dumb money, quote, retail, when were they the most invested? At the top. When is retail getting out? Right now. When are institutions getting in? Right now. See how the spread's widening? Okay. You want to pay attention to this, and we'll do more of a deep dive this Saturday. Make sure you subscribe. Make sure you comment on the length of this video too. I'm making them a little longer. There's just a ton of information to go over right now. Now, tomorrow is quadruple witching. That will be stock options, index future options. These are the three that usually happen on a triple witching. On quadruple witching, it's also including single stock futures. So you would have these three always on a triple witching, and then these on a quadruple witching. Quadruple witchings happen only 4 times a year. They happen January, March, June, and September. And we're having ours tomorrow. Now, why is this important, and what do you need to pay attention to? Off the open, what you will see is you will see massive volatility. You'll see huge swings in volatility, okay? And the reason is because people are trying to get into position and out of position on 4 separate asset classes that are all going to expire. It's usually about trillions of dollars. It's probably 2 or 3 trillion. I don't have the exact number in front of me. So you get this volatility, and then you get that volatility for about the first 45 minutes of the day. Then you're going to start getting this, and you're going to start getting tighter and tighter. Why are you getting tighter as the day goes on? You're getting tighter because of the arbitrage between the 4 asset classes. In other words, they're buying this one, selling this one. And what that does is it just gets you closer and closer to a strike price. So you hit a period of time where you're basically doing this and going sideways. Now, why is this important? Because it changes. Towards the end of the day, very end of the day, probably the last half hour, you'll start seeing this. And when you start seeing this is when you have the potential to make money. That is usually what happens. Now, with everything going on in the banking sector, we might have a little more volatility in some of these names. The more volatile names during the afternoon tend to be the smaller cap, because it's the larger cap names that have all 4 of those asset classes against them. So I hope this was helpful. We covered a lot tonight. There's actually a lot more that I want to go over. We'll go over it Saturday. We'll really do a deep dive on a bunch of this. Please comment on the video. If you are struggling with day trading right now, there is a video that I have right here that you need to watch. It goes over a 1 minute and a 5 minute chart. It is 10 minutes long and will save you a lot of aggravation. I've gotten really great reviews on it and a lot of great comments. So I'm going to create more content like this. Everybody have a great evening. Trade to win.